China, the world's second-largest economy, often dubbed the engine of global growth. For decades, China's rapid economic expansion has been a marvel, pulling millions out of poverty, fueling global trade, and driving demand for everything from raw materials to high-tech gadgets. However, the narrative has shifted. China's economy has been slowing down for over a decade now, with growth rates stalling at 6% in 2019 compared to the double-digit growth of 10 to 14% in the 2000s. This isn't just a problem for Beijing, it's a global concern with far-reaching implications. Today, we're diving into what China's economic slowdown means for us all, and why it's something that should be on everyone's radar. The rise of China's economic powerhouse. To understand the impact of China's slowdown, we first need to appreciate how integral China has become to the global economy. Over the past 4 decades, China transformed from an isolated agrarian society into the world's manufacturing hub. For example, Shenzhen, which was once a fishing village, is now a bustling metropolis with a population of over 12 million. China's rise was fueled by government-led infrastructure investments, booming exports, and a massive labor force willing to work for low wages. This combination turned China into the factory of the world, producing everything from clothes and toys to smartphones and automobiles. By 2014, China became the largest economy in the world, based on purchasing power parity (PPP), overtaking the US. As China's economy grew, so did its influence on global markets. The country became the largest importer of commodities like oil, copper, and iron ore, driving up prices and benefiting resource-rich countries around the world. Meanwhile, China's burgeoning middle class, which grew to 400 million people by 2020, created new markets for luxury goods, cars, and technology, making it an essential growth driver for multinational corporations. But the same factors that propelled China's rise are now contributing to its slowdown. The causes of China's slowdown. China's economic slowdown didn't happen overnight. It's the result of a combination of internal and external factors that have gradually taken a toll on the country's growth. By 2022, the growth rate fell to 3%, one of the lowest rates in decades, exacerbated by the COVID-19 pandemic. One of the key factors is the transition from an export-driven economy to one focused on domestic consumption. For years, China relied heavily on exports, which contributed 30% to its GDP during the 2000s. As wages rose and global demand shifted, the model became less sustainable. In 2013, the Chinese government officially recognized the need to rebalance the economy, shifting from export-led growth to consumption-driven growth. However, this transition has been slower than expected. Another significant factor is China's aging population. The one-child policy, in place from 1980 to 2015, led to a demographic crisis. By 2023, the working-age population had declined by 41 million since its peak in 2010, and the number of retirees is expected to rise from 240 million to 400 million by 2040. This demographic shift is reducing the labor pool, increasing social service burdens, and pressuring economic growth. Additionally, China's massive debt levels, which reached $50 trillion by 2023, over 300% of its GDP, are a serious cause for concern. Rapid growth was largely financed by debt, with local governments and state-owned enterprises borrowing to fund infrastructure and investments. With slower growth, debt servicing is becoming increasingly difficult, raising the risk of defaults. Externally, ongoing trade tensions with the US have added to the slowdown. Tariffs imposed during the 2018 to 2020 trade war disrupted supply chains and led to reduced export demand. In 2022, China's trade surplus with the US remained at a hefty $310 billion, but overall, export growth has been subdued. The global ripple effect. China's slowdown isn't just a Chinese problem, it's a global one. Given China's role as a major player in the world economy, any change in its economic trajectory affects the world. One of the most immediate impacts is on global trade. As China's growth rate decreased to 5.5% by 2024, global trade volumes took a hit, particularly affecting countries like Australia, where 40% of its exports are destined for China. Similarly, Germany, which relies on China for 8% of its total exports, has already seen slower demand for machinery and automobiles. Commodity prices are also affected. China is the world's largest consumer of iron ore, oil, and coal. As its economy slows, demand for these commodities drops, pushing prices lower. For example, global iron ore prices fell from a peak of $233 per metric ton in 2021 to $90 in 2023, hurting countries like Brazil, Russia, and South Africa. Global financial markets are feeling the impact as well. China's stock market, which saw a 30% drop in 2022, sent shockwaves across global indices. And concerns about China's financial stability have led to capital outflows of over $150 billion in the same year. The technology and innovation challenge China's slowdown has significant implications for global technology and innovation. Over the past decade, China emerged as a major tech player, with companies like Huawei, Alibaba, and Tencent. By 2020, China accounted for 23% of global R&D spending. However, as the economy slows, the tech sector faces new challenges. Reduced consumer spending, along with the government crackdown on tech giants in 2021, has stifled innovation and growth. For example, Alibaba's market value dropped from over $850 billion in 2020 to $320 billion by 2023, as regulatory pressures and market uncertainties took their toll. This slowdown could affect global tech advancements. China plays a crucial role in 5G, AI, and electric vehicles. Slower innovation in these areas might create opportunities for companies in other countries, but it could also delay technological advancements globally. The geopolitical implications of China's economic slowdown carries geopolitical consequences. The Belt and Road Initiative, BRI, a cornerstone of China's global strategy, has faced delays and reductions in scale as the economy contracts. By 2023, 20% of BRI projects were suspended or cancelled, reducing China's influence in Asia, Africa, and Europe. Tensions with the US are also exacerbated. As China's economy struggles, the country might adopt a more assertive foreign policy, leading to increased friction with the US and its allies. This could manifest in further trade wars, military posturing, or diplomatic conflicts, destabilizing the global order. The human cost. China's slowdown has a significant human cost. Millions of Chinese workers, particularly in export-oriented industries, faced job losses. By 2023, unemployment in urban areas had reached 6.4%, the highest in a decade. Social unrest is becoming a real concern as income inequality widens. For China's middle class, numbering 700 million, the slowdown threatens their upward mobility as property prices and job opportunities stagnate. The dream of continuous improvement in living standards may no longer be a given for many Chinese citizens. What does this mean for us all? China's economic slowdown is a reminder of the interconnectedness of the global economy. From higher prices for goods to investment losses, the effects of China's economic deceleration will be felt across the world. For businesses, this means rethinking supply chains and investment strategies. Policymakers must focus on global cooperation to address economic challenges, while individuals may need to brace for ripple effects in job security and prices.